Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. It's Tuesday. It's July 19th, 2022. The market's going to open up in about an hour and 31 minutes, to be specific with you. Now, the Dow Jones is opening up about 170 something up, at least for now. NASDAQ is up pretty good at 86, and the S&P is meeting us in between. Now, it's very important that we focus on the fact that the market opened up pretty good yesterday and actually went down. And today it's opening up pretty good. It'll be very interesting if it can sustain its momentum levels. That'll be a very, very important thing that we're going to be looking at today, especially in light of all the earnings that are coming out. Before I get into earnings, we also have housing starts and permits. Now, last year, this number wasn't as relevant because the housing market was doing really, really well. But now the housing market is cooling off because of higher inflation. And that's impacting the housing market. So you may see a little bit of a cool off here. But quite honestly, unless it gets really, really bad and we're nowhere near there, I think the number is going to be fairly stable. The expectations are housing starts and permits is 1.66 million and housing starts 1.58 million. And we'll see if the number, and as you can see here, the expectations are not that out of whack. They're actually fairly reasonable. Not expecting anything crazy. And tomorrow we'll have an update on existing home sales. I think this number has gotten down because prices haven't been going up. And at least in this area, we've been seeing a slowdown. Then we've got the manufacturing index and the PMI. Those are going to be the big reports because jobless claims, although it has been tracking a little bit, spiking a little bit higher, it has been not too bad. It's been fairly solid. Now, earnings. Folks, you may want to write this down today, and I'm not sure if it's before the opening or after the opening or maybe one of each, but we've got Johnson & Johnson. They're expecting $2.57 per share. That's 3.6% higher year over year on 2.2% higher revenue, $23 billion. What you need to remember is $2.50 a share, and if it's below that number, we can be in the deep doo-doo. Netflix, oh boy. Netflix is expecting to, I know this is after the closing bell, I know that for sure, as I was just reading about it. They're expecting pretty much flat EPS, about $2.96, just a little bit below $3 on revenue of $8 billion. That's a 9.5 year-over-year increase, and I think that's pretty ambitious, to be quite honest with you. I'm a little nervous of Netflix. Aside from that, we've got Interactive Brokers, want to see how they're going to be doing in terms of opening accounts, if the accounts are starting to come in again, or if people are backing away from stock trading. That's going to be very important, more important than the actual number. Then you've got Halliburton and Lockheed Martin. You've got the defense companies and the oil companies. It'll be very important and very interesting to see what they report. So again, Lockheed Martin, Halliburton, Interactive Brokers, and then these two wild birds over here, Johnson & Johnson and Netflix. Not sure if Johnson & Johnson is coming out before the opening bell or after, but we can take a quick look here. Probably give us a good idea. Down 2%, up $1. I don't know. I don't know yet, but we will find out soon enough. But these are the numbers that you need to remember. You may want to take a screenshot of this. Here it is, so you could see exactly what's on the docket today. Now, in terms of global economy, not too many updates, not too many things that are unknown, but we need to go through this. Global shares were mostly lower Tuesday, which is another factor that's dragging U.S. markets. Investors weighted oil prices. Remember, oil prices have been going down. That's less of a factor causing inflation, which means we might have peaked. Inflation worries, corporate earnings, that's what's in key. And COVID. We've got another nasty breakout happening, but it's not deadly. That's the key. Analysts said Tokyo market was seeing some buying after a 3-day weekend. Monday was a national holiday in Japan, so they're just getting going now. Corporate profits, I can't speak so early in the morning, are under threat given high inflation and a slowdown in parts of the economy, though analysts are still forecasting continued growth. Markets are likely to remain volatile. Oh yeah. Through upcoming earnings season, Johnson & Johnson, American Airlines, Tesla are among dozens of companies scheduled to report this week, as I've shown you yesterday and today. The U.S. market has been lurching, I like that word, lurching, mostly lower for weeks on worries that the Federal Reserve and other central banks will slam the brakes too hard on the economy in hopes of bringing down inflation. If they're too aggressive, they're going to cause us to go into a recession. But I think the market is already pricing in, the prices are already reflecting a recession. A key report released last week indicates that expectations are easing for inflation among households. That's right, consumer sentiment is getting better, which is really great. And that could prevent a more vicious cycle from taking root and easing, putting less pressure on the Fed to take action. Expectations are now falling. They're going back down from a full basis point rate hike to 3/4 of a basis point rate hike because consumer spending is in fact increasing and consumer sentiment is in fact getting slightly better. Now, here's where it gets really, really hairy and tricky. If you look at the stock market over the last 5 days, look at this. Consumer discretionary tech stocks. But look at what's right behind it, energy and financial consumer staples. I mean, we're all over the place. And if you look at it yesterday, energy and materials are leading again. We're literally all over the place. And I mean, this is why right now, again, energy is now leading, consumer staples is lagging, healthcare is number 3. But look on a monthly, consumer discretionary, healthcare, technology, consumer staples all the way down here now. We're going through something right now, and it's earnings mostly, but there's a lot of unforeseeability. There's a lot of sector rotations happening right now. So you've got to be very, very careful. So looking at the sectors individually, we still have a pretty good congestion and consolidation in the consumer discretionary. Healthcare looks like it's kind of choppy, a little volatility, but I'm not ready to say downside yet. Technology and consumer discretionary, as you could see here, are looking almost identical, and they've been tracking each other. Real estate isn't doing anything, also congesting very similarly to consumer discretionary, kind of playing wait and see. Look at utilities, choppy. Look at communication. Communication looks exactly like consumer discretionary and technology. Look at that. Just choppiness without any bias. Consumer discretionary looks that way. Basically, what I'm trying to get at is markets are looking to consolidate. Energy looks like it can go a little lower today. Looks like it can bounce down. But I'm not really seeing anything crazy here, any major movement. If we break down in healthcare below the 124, and if we break down in consumer staples, we could be going a little lower. But right now, with the consumer discretionary and the technology and real estate and financials could go a little lower. And industrial, basically most of these sectors are going through a congestion right now, which is not all that different from what we're seeing in the bond market. This is why I'm looking at the bond market for clues as to future movement. And right now, it looks like we're entering a choppy period, and we've been in this period now for over 2 months, and it looks like we can stay there. If that's the case, markets are going to stay volatile, but this directional bias we've been seeing, all of this is going to lead more into a congestion and consolidation, which means eventually volatility levels could be lower. Let's look at the volatility on the Dow right now. But I'm not expecting too much from the market this week, especially with this congestion that's happening. And it's about time. I'll tell you this too. It's about time because, I mean, the markets have been really volatile. And here, it looks like volatility. This is volatility. Volatility is going lower, definitely going lower. So expect more consolidation, expect more choppiness and less directional bias, which we really need right now. Look right here. Ever since the NASDAQ went in a choppy period, look at volatility. It's been going lower. And volatility now is, excuse me, back to where it was when this correction first started. So again, we may have a little bit of an increase in volatility and trading range, but you got to keep your eye on the broad market and see if it continues following the long bond. In terms of individual stocks that I'm liking right now, it's very tricky right now because, again, you still have Occidental Petroleum as number 1, but most energy stocks are nowhere to be found. Remember a few months back when energy was up here? Now you've got Valerio down here, Enphase up here, Exxon, but most of this is healthcare and consumer staples, as I said to you guys over a month ago. So be very cautious. Kellogg's, Campbell. It looks like markets are going to lose their directional bias for a little bit and just kind of consolidate and congest, which could be a very good time for swing trading. Be a little bit up, a little bit down, a little bit up, a little bit down. Like this type of a period could be very, very fruitful. And again, if we see more consolidation like this, don't be surprised. Don't be surprised. Especially, look at the trend we've seen. After a long trend, long directional trend, the market's changed direction. What do I always tell you guys? After a vertical trend, the market goes horizontal. After a horizontal trend, the market goes vertical. Long trend in either direction, and then a long period of consolidation, and then another trend. Well, if economy gets better, this will start moving higher. If economy gets worse, this will start moving lower. But I would be looking at the bond market more than anything else for directional bias right now. And I would be looking at which stocks are remaining in lead and which stocks are in the lag. And again, look at this. Royal Caribbean, Bath and Body Works, Dish, PayPal, same Norwegian Airlines. I'm not going on those airlines if you pay me. The bottom line is keep your eye on top stocks and bottom stocks, and they'll tell us everything we need to know. Sectors are getting a little choppy right now. We're entering August. Consolidation, a little choppiness, wait and see, not surprising. Be very, very, very cautious during this earnings season and don't expect major breakouts. Now, today at 1 p.m., I have a class. It's called Pattern Trader. Now, this is something you need to be excited about. Let me show you why. So these have been all the trades that we've taken since we started the program. Now, here's the stock winners and here's the option winners. Now we started this 523. We took the last trade about 5 days ago. We've been going kind of slow, about one trade a week, nothing crazy. Markets have been going crazy. Here's the returns we've been getting. Here are the days we've been in the trade. Here's the profit factor before we take a trade. We know what the profit factor is. We know what the historic win rate has been before we take the trade. Here's the entry. Here's the exit. Here's all the ticker symbols. So I want to tell you something. Since we launched the program on 5/24 or started our first trade, we haven't had a loser. We haven't had a loser. I can't calculate my profit factor because I need a loser to calculate my profit factor. Average return 16.24%, average hold time 3 days. Something you'd be interested in? No losers in the last 2 months with this kind of market cycle in a brand new Pattern Trader program. And you're probably thinking to yourself, we probably should have taken Roger up on this. These look like pretty good gains. 3 days, 23%, 4 days, 31%. Look, even 3 days, 5.95%. You'd have to wait 365 days to get that from the stock market. I think most of you would really like this. So you want to learn how I generated these trades, how I set it up, how it came about, how I back tested, how I traded, how it all works, how it all came together. Of course you do. Where else can you get 9 winners in a row in this crazy market in real time? We just closed out Apple a few days ago for a juicy 23.66% gain. Took a nice little bite out of that big fruit. Anyway, and look at this. Perfect swing trading periods. There's nothing bad I could say about this. What can I say negative about this? I can't calculate my profit factor. I need a loser to calculate my profit factor. 9 winners in a row. Folks, learn about Pattern Trader today. It's happening at 1 p.m. Eastern Time. I'm going to review the newest and the coolest launch since we've launched it in May. But you don't have to take my word for it. I'll show you every trade we've taken so far. I'll show you all the details. I'm releasing a brand new trade for free. I may even give you the ticker symbol. You got to come in there. This is the only place you'll get access to my new way of trading, where you get your profit factor from all historic trades and your historic win rate ahead of time. So you see exactly why I placed the trade. Make sure to save your seat. Click the link below. This event is going to be packed because people want to know how these pattern traders came about, how they trade, how the setups work. We even scored a bonus trade on the Russell, a cyclical trade. Anyway, we've been on a roll here. I want you guys in on it. Check out Pattern Trader, 1 p.m. Eastern Time. It's happening. Do not procrastinate. Do not miss out and save your seat. Bye. Have a great, great day.